Ladies and gentlemen, welcome back to the channel. Tesla stock came under pressure today, partially because of the news we talked about in the video earlier today. But then, like 30 minutes left of the trading day today, there was big news that came out that's kind of confusing, but it sounds really negative. So we'll get into that here in this video. Now, Donald Trump said some things about China that you absolutely need to hear. One thing in particular that I've been talking about on this channel for a long time, and one of the key reasons why I am so bullish on this market and so bullish on AI over the next 5, 10 plus years, okay? Trump just acknowledged something huge. Now, beyond that, we do have some economic data coming out tomorrow morning and tomorrow about 2 p.m. that I will share my perspectives on. We have a couple comments from Fed governors today that I will also share with you. And there's a couple of clips on CNBC I think you really need to hear because there's a lot of noise out there. There's a lot of people that are fearful about inflation. They're fearful about growth and earnings and all of this. But when you put everything together, we actually have a surprisingly positive economic backdrop coming, at least in theory. Like some of the provisions in the big, beautiful bill are very stimulative, very good for CapEx in particular. And we'll discuss that here in this video. Ladies and gentlemen, hit that like button and subscribe to the channel if you have not done so already. So first things first, the big news that came out like literally 30 minutes before the end of the trading day today was, quote, the Trump administration nominee to head the U.S. Auto Safety Agency says regulators, quote, cannot sit back and wait for problems to arise with self-driving cars. Written testimony. So it sounds like a little bit of an attack on Tesla, even on Waymo, that there may be frameworks put out soon for autonomous vehicle programs, guardrails, if you will. I think Tesla is already taking those measures. Like there is somebody that remotely monitors robotaxi rides as is that could intervene remotely if they needed to. Like, I think Tesla's already following the unwritten guidelines, if you will. But this doesn't sound like a great headline. And when this news came out, Tesla started to sharply sell off. I just want to say, like, I think Tesla's fine. I think autonomous vehicle programs are going to be fine. Could there be some more negative headlines or more concern, if you will, from the administration around this, especially given Elon Musk and, well, Trump do not have the greatest of relationships these days? There could be. But does it change anything? No. Now, before we get into the rest of your breaking news and developing situations that we must cover here in this video, including what Trump said about China, first things first, check out that link down below in the description of this video. Long story short, what we are doing over there is finding distortions and opportunities in this market. For an example, one company that I have now over 8,000, 10,000 shares, and I believe it's 10,000 shares, including the options positioning, is trading at less than 6 times sales. It is a pure AI company with hyper growth, growing at hundreds, maybe thousands of % because they didn't have much revenue last year, that is at 6 times sales. Whereas if you look at Nebius, a company I bought at $17, it's currently hit $55 today. Well, that company trades between 12 and 16 times sales, depending on what range of guidance they hit for this year. So this company, just because it's a small cap company that has virtually no analyst coverage yet, and has no retail investors that really back it, it's trading at a third of the valuation, and it's 100% pure play AI company growing faster than Nebius is. Yeah, doesn't make sense to me. We're finding distortions out there in key areas of growth for the next 5 to 10 years. AI, robotics, energy related to AI, select biopharma names as well. And what we're doing is we're investing in the quality companies that are small caps and not investing in the bad ones. See, when you buy the Russell or you want the outsized returns that come with small caps and you buy an index, you're buying a lot of bad companies as well. You're buying a lot of zombie companies that shouldn't even exist. What we are doing is finding the opportunities, the 10, 20, 30, 40, 50x opportunities within these key themes that are underlooked by markets. In theory, you should create a much lower risk profile than, let's say, just the index itself, and much more upside potential. That's the idea, at least. And that is what we are executing, and our portfolios are the proof. If you guys want to come join that, get access to all of the trades that we are making. Every time I make a trade, I send out alerts. Check that link out down below in the description of this video. The idea is to take a portfolio from $75,000 today over $1 million by the end of 2027. That would be like a 12-ish X from where that portfolio currently is. So we do have some lofty ambitions. Portfolio is already up over 65% this year. I think it's going to be up a lot more by the end of this year. Already getting some incredible results. So come join us if you have not done so already. And back to the episode. Now, Wells Fargo's CFO says consumers and businesses are largely in good shape. Now, it's important that we pay attention to a lot of the commentary around earnings season because the economic data is noisy, right? Data we get for the economy a lot of the time doesn't make much sense, right? We see like a payrolls number that's positive 150,000, and then you look at the private payrolls number that's negative 33,000. Then you look at the household survey that's negative 200,000, and you're like, what the hell is going on? Okay, well, executives at companies on earnings calls and, you know, from a corporate perspective, they cannot lie. They are legally obligated to tell the truth, whether it is good or bad, what they are saying. Okay, so whatever headlines we start to hear about the consumer and the business landscape and all of that, we want to pay very close attention to it. Now, Donald Trump says that more investments will be announced in the coming weeks. Trump says that China is going to be very far behind, and he says that we are way ahead of China. But this is the big headline that I really want to point out and highlight for all of us. Trump says, we'll be fighting China, quote, in a very friendly fashion. He's referring to an AI Cold War. That's what he's referring to. That's what he's talking about. This is something I have talked about on the channel a lot in recent days and weeks. This is one reason why I'm so bullish on AI and so bullish on our markets. Because Cold Wars, they demand innovation. The country that innovates the fastest and the best wins. No matter who really wins, if there needs to be like a winner, both countries and really the world are going to see rapid innovation and a lot of investments. This is very positive for the stock market, okay? Specifically when it comes to AI. Like, this is a once in a lifetime opportunity. AI is. And the fire that is lit under, you know, AI companies' asses in the US, AI companies' asses in China, is due to this Cold War, this unspoken war that is going on, this race to the top as far as technologies is going to make a lot of us very wealthy if you're investing in the right areas, okay? And that is what we are doing in the trading community. I'll be damned if I look back 10, 15 years from now and say, wow, I just missed it. I missed the biggest revolution since the internet. Nope, will not happen. But even Trump is now acknowledging that we are in a Cold War with China. That is literally what he said here. Trump says that nations that don't open up will pay a substantial tariff. And Trump says that, again, more investments will be announced in the coming weeks. Trump also touts the tariffs and the Indonesia deal that was announced today. Fed Collins says, I am seeing some evidence of a slowdown in labor demand amid a slowdown in labor supply growth. He says that changes in interest rate policy may play out over different horizons. Honestly, I don't know what that means. He also says, we don't know exactly where maximum employment is. Collins says it's time for the Fed to be actively patient with monetary policy. He says, I expect downward pressures on employment and growth. Again, as I've said before, tariffs are not inflationary. They do not add to the money supply. It is a tax. Taxes are never inflationary. Yes, taxes can cause a one-time price increase, okay? But like the last couple of years, okay? You don't get a last couple of years like inflation problem like we've seen in the last couple of years or in the 70s or whatnot because of a tax. That doesn't happen. So sure, can you see prices go up within a 1, 2, 3 month time span because of tariffs? Sure, anything's possible. But you're not going to see this inflation problem that persists for a long time because of tariffs. That's just never going to happen. Inflation is only ever a monetary phenomenon. Monetary, aka money. Money printing. Overproduction of the money supply. That's what causes inflation, not tariffs. The idea is that there's so much money out there that consumers are so healthy and the labor market is so strong that people are going to pay higher prices and then get higher wages from their companies and introduce a wage price spiral. Good luck with that. That's never going to happen. I think most Americans, not most, but a good chunk of Americans, probably a third of Americans, are in a very dire financial position right now. You are probably not one of them if you're watching this video investing in stocks. Let me put that out there. So just to be clear, you're not in that category. So if you comment like, the economy is so strong, blah, 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 you're not in that category, okay? But a third of Americans, from what I can see, roughly, are in dire financial situations. There will be no inflation. The faster people realize that, the better off they will be investing their money in their portfolios. U.S. Department Treasury Secretary Falkender on CPI says overall the index is getting back to below the Fed's target. He says that CPI numbers raise the question whether the Fed is in the right spot. Again, I do just want to be very clear here. What happened today was bond yields went higher, okay? 10-year Treasury yields went up 6 basis points, but inflation actually came in largely in line with expectations. I think it was mainly an algo-driven reaction today because the month-over-month readings looked bad, right? You went from 0.1% core CPI last month to 0.3% core, or is it 0.2%? I think it was 0.3%. 0.2% for core month over month. So that rise kind of hit the algos in a weird way today. But the VIX was only up 1%, even though the Russell was down 2%. Okay, so like the Russell selling off that much, you would expect the VIX to be up a lot more. The Dow is down 1% and the VIX was only up 1%. That's not screaming. There's a lot of fear out there in markets. Now, also, we had the news that NVIDIA can now sell H200 GPUs in China, which kind of sucked a lot of money away from certain areas of this market, like small caps, into other areas like NVIDIA, right? Like your other semiconductors. And those companies are so large that, I mean, like what, a 4% move higher on NVIDIA is, you know, 100 billion market cap, something like that. That's a lot of money to get siphoned from one area and moved to another, let alone all of the other AI stocks that did well today. So I think there was a little bit of a push and pull, but the bottom line is, like, today was not a super negative day from an overall perspective, right? You're not seeing signs that the rally is like over at this point. Even though the Russell sell-off did look extreme, the VIX did not scream we have a problem. Tomorrow morning, we are going to get PPI month over month for June. You're expecting, again, a rise here from 0.1%. You're expecting that to rise to 0.2%. For core PPI, again, last month was 0.1%, expecting that to rise to 0.2%. And core PPI year over year for June was 3% last month. You're expecting that to fall to 2.7%. So again, I think it's kind of like today's number. If it comes in high, it's not going to be seen as great, but it's not the end of the world either. Now, coming out throughout the day, tomorrow, Fed Hammock speaks in the morning. Industrial production comes out as well at about 9:15 a.m. Fed Bar will speak. Manufacturing production month over month and year over year. So a couple smaller data sets will be coming out. The Fed Beige Book comes out at 2 p.m. Now, even Powell himself has said, hey, the government economic data is pretty noisy. Read the Fed Beige Book if you want an idea of what the economy is really doing or how the Fed is really looking at the economy. It's basically like a short summary of how each Fed district is doing in terms of prices, manufacturing, services, inflation, all kinds of different things. The Fed Beige Book is something you definitely want to read. We will read that together in the video that comes out tomorrow night. Just keep that in mind. Come back to the channel at 8 p.m. or 4 p.m. and we will we'll have that rundown for you, but you definitely don't want to miss it. Now, also tomorrow morning, you have ASML that will report earnings. Now, ASML is like tier 1 of the AI story, right? You have Lam Research, ASML, you have, some of those companies that really supply like a TSMC, right? So ASML is even first in the supply chain, if you will, of the AI story. So it's like ASML, it would be TSMC, next it would be NVIDIA next, and then it would be like the application from, GPU products that would come next, like a Meta or a Netflix or Tesla or whatever it is, right? So ASML is going to be a very important company to watch tomorrow because they're going to tell us quite a bit more about the AI story right now. You also get Bank of America, Goldman Sachs, Progressive, Johnson & Johnson, Morgan Stanley, PNC, M&T Bank, and Prologis that will also report. So you're going to get a lot more in terms of banks and commentary, as well as, again, that kind of update from ASML, and we'll see where the AI story is overall following those earnings. Tomorrow and after hours, United, Alcoa, Kinder Morgan, First Industrial, and some other banks will report. But Thursday is the big day. TSMC, Pepsi, PepsiCo, Cintas, U.S. Bank Corp, Abbott, Texas Capital Bank, Webster Bank, and Novartis will report, as well as Fifth Third Bank. Also, almost forgot them. Thursday and after hours, Netflix, Interactive Brokers, Lockheed Martin, Bank of Ozark, First National Bank, Simmons, Western Alliance Bank Corporation. I remember when people were scared that one was going to go bankrupt. That was a crazy trade a couple years ago. Nonetheless, you do have a bunch of earnings throughout the rest of this week, even Friday morning, which is typically not like a big day for earnings. You have Huntington, 3M, Truist, SLB, American Express, Charles Schwab, Ally, Comerica, like some pretty big companies actually on Friday. Specifically, you want to see what American Express has to say because that's directly tied to consumer credit, right? So if American Express has good things to say, then that's a good sign for the economy, something I will be paying close attention to. Now take a listen to what Morgan Stanley's Mike Wilson said on CNBC today. The title of this clip is NVIDIA China Return Adds More Fuel to the AI CapEx Fire.
Right now for his take on the markets is Mike Wilson. He's Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. And Mike, it's great to see you.
Morning.
Before we talk more broadly, can you just comment on NVIDIA, what that means maybe for tech companies writ large?
Yeah, I think this is back to the issue we've been dealing with is like what's going to be sanctioned, what's not going to be sanctioned. I mean, the 232, like what's going to be carved out. So this is a step in the right direction for semiconductor companies broadly, I would say. And let's not forget that they took a large write-down for those same chips.
$5.5 billion
correct.
Just a few months ago.
And now apparently they can sell them. So that's going to be a huge positive kick to margins, going forward. And look, one of our big themes this year as we came in was that AI CapEx was going to slow, decelerate, and then all of that troughed in April. And I think that explains a lot of the sell-off in the first quarter and a lot of the recovery. It doesn't get a lot of attention, though. People are focused on tariffs, they're focused on other things that are going on. But the AI CapEx cycle has been very important for the overall market direction, first down in the first quarter and then the recovery in the second quarter. And this deal or announcement, I think, is just more fuel to that fire.
What do you think overall? I know that you believe the One Big Beautiful Bill was very positive to have that passed. And I think you are writing off a lot of the worst headlines for tariffs at this point, too.
Well, that's right. I mean, I think we had a lot of bad news in the first quarter. Once again, there were many headwinds to growth. A lot of those, some of those were policy driven, some of those were not policy driven, and they all seemed to sort of bottom in the April period. So the market has moved on from tariffs as the worst is behind us. It doesn't mean that we don't still have bad news or issues in front of us, but it's moving beyond that. And the Big Beautiful Bill did sort of wrap up a lot of the things that are now going to lead to positive things for earnings growth, both in the second half of this year and into next year. So as we said at the beginning of the year, President Trump came in, he's like a new CEO. They kitchen sink things, right? They did all the growth negative things first. And I think the Big Beautiful Bill is part of that positive transition now to really earnings growth more so than economic growth. And I think the market understands this. This is why people are very confused about why is the market up? Why is the market up? Well, earnings revision breadth has turned straight up. And we've been talking about this for 3 months. And the Big Beautiful Bill only supports that view further.
Earnings, we're just starting to hear the first of the banks reporting now. I think earnings growth of 3 or 4% is anticipated overall. You think it's going to be better than that or not?
Yeah, I mean, these companies manage these earnings. So I'm very confident they'll beat by 4 or 5% as typical. And here's the key for earnings. I think the first 2 quarters, we didn't see the impact of tariffs because companies sort of pre-bought a lot of goods. And so we're not seeing the flow through to the cost of goods sold. If there's going to be an earnings risk story, it's probably in the third quarter, but it's back end load. Financials don't have impact from tariffs, right? It's going to be in the consumer goods space. And those companies tend to report in the back half of the earnings season. So I think August is going to be the period where we could have some sort of corrective activity around the earnings, but that's a pause. Because my view is that earnings are going to reaccelerate in the fourth quarter and into 2026.
Mike, President Trump is... he does things that are unexpected. Some people think that's a benefit with our enemies not knowing what the heck he might do at any time. But one thing that seems consistent is if Jensen Huang goes to him and says, look, NVIDIA is going to be severely hurt if we can't do that. Or if Tim Cook goes to him and says, look, if we can't build our iPhones right now in the United States without them costing... He seems... to be, you can talk to him, and if it's about business and about companies succeeding, even with tariffs, I think if the big three come and say, look, you're doing this, you got to carve this out for us if we're getting seats from Canada. He seems to err on the side of trying to help businesses. Can we count on that? That would be nice if we could count on that.
Well, I think we've learned that over 2 terms now, right? I mean, then the market is onto this idea that, yeah, it's a negotiating strategy to go way over here. And then there'll be carve-outs, right? And things like rare earth metals, right? It's another one. And the magnets, I mean, that's another one where they're making concessions.
No one really wanted to deprive everyone.
Well, so then the question is, when it comes to tariffs, what do you think we ultimately get or not?
Less.
And by the way, though, if we all know this, don't our trading partners know this too?
And then they don't negotiate.
They do, but
don't they look and go, this, right?
Yeah, but that's why I think the market is saying we're going to settle somewhere in the middle. So my view personally has been for a while that this is going to end up looking like a 10% consumption tax, sort of like a VAT. And the idea there is that it'll be shared between exporters, importers, and consumers kind of equally. We can live with that. And that's where I think the market has settled on. Could I be wrong about that conclusion? Sure. Could there be situations where it's a little bit worse, perhaps maybe with Vietnam or some of these other countries, maybe even China? But at the end of the day, if we can collect 10% tax on all imports, that's $400 billion a year. I mean, that's real revenue. Right. I think that's the goal here it's a revenue generator. OK, we can live with this. It's a shared tax across those 3 constituents and businesses will figure it out. And I think that's why the market it's not complacent. It's just that's where it's settling.
So I think that was a great take from Mike Wilson. I would agree with what he said there. I also want to share this clip with you as well. It's only about 3 minutes long. It says, we're not going to get a big inflation surge here, says Ironside's Barry Knapp Take a listen.
Absolutely critical, not just for the current Fed chair, who I respect, but for the next Fed chairman. And our next guest says this is another soft read. He still expects the Fed to cut by a full point this year. Let's bring in Barry Knapp of Ironsides Macro. Barry, it's great to see you. This has to be like a curriculum in a box here. Why do you, and I'm sympathetic to this, but again, the bond market's not acting like we can look through all of this inflation. Look at the 30-year today, right? Look at the 10s. Do you think that's all global? So where does the dovishness come from?
Yeah, there's a lot in your intro here, Kelly. As far as the Treasury market specifically, the pressure really isn't on the back end today. It's really in the belly of the curve, and it's the real rate component or TIPS yields. I think that has to do with the monetary policy outlook, this idea that inflation is coming from tariffs. I think that's totally wrong. As we discussed last time I was on set back in June, inflation is always and everywhere a fiscal and monetary phenomenon. So if you just consider the conditions that exist today versus 2021, I look back at the CBO budget report in March 21. Spending was up for the first 6 months of that fiscal year 45%. Right now, it's up 5%. That's slowed from 7%. And on a month-on-month basis, it was down 7%. So fiscal policy, the sending of checks to everyone that facilitated the big spike in goods prices during the whole COVID supply chain related disruptions, is in the opposite position it was back in 2021. The same is true of monetary growth. Money supply was expanding 27%. Right now It's expanding 4%. So 50-year average is 6-7. So we're not going to get a big inflation surge here. And I think we're going to see very soft growth numbers over the next month that are going to convince the Fed that Waller's right. You know, that as the dust settles or dirt settles, as Goolsbee put it, the Fed should have been easing and will find themselves behind the curve in September, just like they did a year ago.
If so, would you say we should all be buyers of bonds here, that these rates are coming down? Or do you think they're high because of what's going on with the debt and deficit or what's going on with the independence, quote unquote, of the Fed?
Well, for the, it's funny, I gave a speech to a bunch of energy CEOs in Denver last week, and my net takeaway was still that you should be underweight the back end of the Treasury market. I've been at 70-30 all year, 70% stocks, 30% bonds. There are some other things going on in the back end of the Treasury market, for sure. I mean, the JGB market, which has been the anchor of global bonds, as Peter Boockvar puts it, for decades, is under a great degree of pressure. They have upper house elections next week. The slowing of QE is a huge problem in Japan, the spending out of Germany. So there's a lot of pressure on the back end of the curve. It's unclear how Treasury Secretary Bessent is going to approach the financing. I'm not worried about the deficit expanding here. And as I said, government spending is easing. But the back end of the Treasury market is still not where I would be. I would say probably the 2-year to 5-year part of the curve probably represents a really good opportunity, because if I'm correct and we get a really weak core GDP number at the end of the month, we get another 4th consecutive big negative revision to the benchmark estimate for payrolls for the year ended March. We get another weak employment report where the internals are really soft like last month. The Fed will find themselves behind the curve and will have to play catch up, in which case, if you bought 5s, you'll do really well.
So let me know your thoughts on all of this down below in the comment section. I just will say, I've been talking about a consolidation phase for a while. Seems like we've been in that consolidation phase for really 1, 2, 3, 4, 5, 6, 7, 8, 9 trading days or so now. I'm not super shocked by this. I think it's consolidation before we make the next move higher. I don't think this is the start of a larger correction. Me personally, again, not a financial advisor, not a financial planner. Do what you guys want. Okay, that's just my take. Come join the trading community. Link down below in the description of this video. The most unique service you could ever imagine. That is, I think, the coolest thing that anyone has ever done in the financial space. Like going out, finding the value in small caps, looking for 10, 20, 30, 40, 50x opportunities. I don't think it gets better than that. you can do this in a healthy way or in a not so healthy way. We strive to do it in the healthy way. So check it out. Link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.